This Chapter 2 illustrates an application of CDS by a bank seeking to mitigate its exposure under a long-term credit instrument. Turning now to hedging applications, we assume that JP Morgan, let's say, has completed a complex 20-year lease financing for Lufthansa. We assume further that the value of the aircraft was initially $100 million and that JP Morgan financed its purchase of this aircraft at 3% under a bullet 20-year financing and then leased it to Lufthansa, and that under the terms of the lease, Lufthansa is required to make quarterly payments of $2 million and a final balloon payment of $100 million. We assume finally that today, 5 years later, JP Morgan is becoming nervous about the prospects for airlines generally and for Lufthansa in particular. Selling down some of this exposure would be the traditional way of reducing risk, but the complexity and the illiquidity of lease paper might make it difficult to interest many banks or investors to purchase or assume any of this exposure. We would say that JP Morgan is long Lufthansa credit risk and wishes to go short some amount of this risk to reduce its exposure. So, as an alternative, JP Morgan approaches Citibank and enters into a 15-year CDS contract on a notional of $100 million, requiring quarterly payments at an annualized 4% or $1 million per quarter. The contract also specifies as credit events a bankruptcy of Lufthansa or any failure by Lufthansa to meet a payment obligation on its publicly traded debts. Finally, the contract identifies any publicly traded senior unsecured bond issued by Lufthansa as an eligible instrument that may be delivered by JP Morgan to Citibank following a credit event under the CDS confirmation. Please note carefully that the lease is not a publicly traded debt, and this point will have important consequences to our evaluation of the hedge's efficiency when we come to it in a moment. In fact, the lease is not even mentioned anywhere in the CDS contract. There are 4 scenarios we need to analyze to understand the benefits and risks of what JP Morgan has achieved. Here they appear, scenario 1, 2, 3, and 4, with scenario 1 involving Lufthansa honoring both instruments, the debt and the lease. Scenario 4, the other extreme, where Lufthansa defaults on both. And finally, scenarios 2 and 3, where Lufthansa honors one of these instruments, but defaults on the other, alternately. We will go through these very carefully in the next few minutes. Scenario 1 is the easiest and is described in the diagram about to appear. First, Lufthansa continues paying $2 million quarterly under the lease, and JP Morgan, in turn, is required to make quarterly payments of $1 million under the CDS. JP Morgan, of course, must also pay a quarterly $750,000 under its financing, priced, as mentioned earlier, at 3%. So JP Morgan is still netting a positive margin of $250,000 quarterly from the combined position and incurs no loss at any point since Lufthansa continues servicing the lease. Of course, Morgan's profit margin has been substantially reduced due to its decision to achieve some peace of mind by protecting its exposure to Lufthansa. The CDS, as indicated in the bottom bullet point, remains alive under this scenario for the entire 15 years and then terminates without a credit event ever having been triggered. These consequences are summarized now in the first row of the table we saw previously, with no gain or loss under the lease, no gain or loss under the CDS, and therefore, in aggregate, no consequences to JP Morgan. Scenario 2 and the other remaining scenarios are more complex. Of course, until there is a default under either Lufthansa's public debts or under the lease, the cash flows would continue exactly as before. But now, under scenario 2, we assume that Lufthansa defaults under the lease, but not under its public debts. JP Morgan as lessor would have a number of options, usually described in the lease agreement, and those typically include either restructuring the terms of the lease while allowing Lufthansa to continue using the aircraft, or alternatively, seizing the aircraft and re-leasing it, this is really re-leasing, not releasing, to a third party, or as another alternative yet, seizing the aircraft and selling it to a third party to recover as much of its $100 million as possible. Under any of these scenarios, however, it is reasonably likely that JP Morgan will incur some loss as a consequence of Lufthansa's default under the lease, and that the economic value of the restructured lease under the first alternative, or of the lease to a new customer under the second alternative, or finally from any foreclosure and sale of the aircraft under the third alternative, would be some fraction of $100 million, which we denote here by a percentage R subscript L that you see in front of you, which is short for recovery in percentage under the lease. Please note that this means the loss to JP Morgan from the default on the lease would then be 100 million times 1 minus RL. Since Lufthansa has not defaulted under the public debt, however, JP Morgan simply cannot declare a credit event under the CDS. So the loss it incurs under the lease will not be directly recovered under the CDS. Morgan, in other words, cannot deliver the lease and exercise the CDS and get paid back par. But we will soon learn, and you should already be able to intuit, that if Morgan decides at that point to unwind the CDS, since it no longer has any exposure, possibly, to Lufthansa, it will most probably enjoy some positive gain from this unwind, whether or not equal exactly to the loss under the lease. And this will be so particularly if news of Lufthansa's default under the lease, or at least news of its deteriorating financial condition generally, has reached the public debt markets, and specifically the CDS market. We will use the letter U to designate the decimal per $1 of the CDS's notional that JP Morgan would earn if it decides to unwind the CDS there and then. So in aggregate, Morgan would earn from the unwind 100 million times U. This outcome is now summarized in the second row of the table we saw before. Under the lease, Morgan has lost per $100 million 1 minus RL, But under the CDS, Morgan has a gain of U, and therefore the consequences of the credit event specifically is a loss for Morgan of 1 minus RL reduced by the gain U in the last column. We should pause and think about how plausible or likely this scenario is. And this is a matter of considerable complexity. But 2 points must be borne in mind. First, Lufthansa's public bonds may contain what is known as a cross-default clause, which stipulates that if the borrower defaults under certain other material contracts specified in this cross-default clause, the bonds themselves will be automatically deemed to be in default as well, even if Lufthansa is still servicing them. The purpose of this kind of clause is to reduce the risk to the bondholders of being the last to call a default under their investment, only to find that by the time this happens, the other creditors have already taken most of the borrower's valuable assets. If such a clause exists, if further it clearly includes lease payments among the material contracts specified within its language, and finally, if the bondholders comply with all procedural requirements necessary to call and trigger the cross-default, which may include some kind of waiting period, delivery of notices, and possibly some minimum percentage of votes in favor, then the bondholders would normally acquire the right to accelerate their bonds and demand immediate payment. Assuming Lufthansa is unable to meet such an onerous and unanticipated demand for repayment, this will amount to a payment default now under the bonds, which would therefore permit exercise of the CDS. And this would make this scenario equivalent to scenario 4, which we will be discussing shortly. The second matter to consider is that an airline experiencing a shortage of cash flow would likely prioritize and decide which among its various suppliers, employees, lessors, creditors, shareholders, pensioners, etc., to continue to make payments to. Market participants generally assume that perhaps the last obligations on which an airline would consider defaulting are its aircraft leases, since those allow the airline to continue flying. Without the ability to fly, the airline would find its revenues quickly approaching zero. Priority for lessors over bondholders on the part of the airline is therefore quite likely, making this scenario 2 arguably the least plausible of the 4 scenarios. In the limited instances in which Lufthansa is still generally in good financial condition, but no longer wishes to use the aircraft subject to the lease for whatever reason, perhaps due to excess capacity, it could in theory choose to default on the lease and give up its right to use the aircraft and suffer any other consequences of that default on the lease, while continuing to service its public debts, especially if the lease default does not trigger cross defaults to other important contracts such as the public debts. More likely, however, an airline in such a case would enter into negotiations with the lessor to terminate the lease by mutual consent in return for payment of some compensation to the lessor for making this concession. Under scenario 3, the airline defaults under its public bonds, but not under the lease. We argued a minute ago that this scenario is the more likely one, since it allows the company to hold on to its aircraft and to keep flying, thereby generating some revenue at least while it figures out how to restructure its operations or whether to liquidate completely. As long as JP Morgan keeps the lease in place and is not required by accounting or regulatory standards or some other standard to take any other action, Morgan would incur no cash flow loss under the lease. Assuming Lufthansa's public bonds at that moment in time, however, are now trading at R suffix B, price per $1 of face value, given the default on those bonds, Morgan would be able to exercise the CDS and realize a gain indicated in this last bullet point, because Morgan would collect under the CDS 100 million and would need to deliver bonds that it can purchase in the secondary market at a price of RB times 100 million. And all of this amount so far, from a cash flow perspective especially, would be a windfall to JP Morgan. Nonetheless, this description would overstate the true economics of the outcome. Whether or not accounting requires Morgan to recognize any loss at this time under the lease, the fact of the matter is that Lufthansa as a credit has become far riskier than it was, and yet it is continuing to pay the same $2 million per quarter under the lease. So from a more realistic and more economically accurate fair value type of approach, the lease as an asset from Morgan's perspective has deteriorated in value, whether or not the accounting rules recognize this. If we denote by RL star the fair value per dollar of the lease, where the star is intended to differentiate this case in which Lufthansa honors the lease from our previous use of the term RL, in which Lufthansa had defaulted on the lease, we would then be in a position to fill in the third line in our grid as follows: a loss of 1 minus RL star under the lease, a gain of 1 minus RB under the CDS, and therefore combining those two contracts together, the consequence has been a net loss to Lufthansa equal to RB minus RL star. Scenario 4, finally, requires very little further analysis, since we have already discussed each of its two legs. You should be readily able to confirm the outcome that now appears in the last line of the table here. A loss of 1 minus RL, this time under the lease, since there has been a default. A gain of 1 minus RB under the CDS, since the bonds also have default, resulting in a net loss of RB minus RL with no asterisk. For those who find any algebra a little intimidating, a simple numerical example follows. We set RL star at 90%, RL at 60%, and RB at 15%. Somewhat arbitrary values in absolute terms, but consistent in relative size to each other, with our assumption that a performing lease on the left is worth more than a non-performing lease in the middle, which in turn is probably worth quite a bit more than an unsecured bond, although exceptions may arise, of course. If the 15% assumption for senior unsecured bonds sounds a little low versus a long-term industry-wide average closer to 45% or so, you should remember that airlines have very high percentages of secured debts and leases, so that little is usually left over for their unsecured bondholders after all pledged assets have been seized. The value of U, the profit Morgan achieves from unwinding the CDS when Lufthansa has defaulted on the lease but not on its public debts depends entirely on what has happened to the pricing of Lufthansa risk in the CDS market. This will be discussed extensively in our module called Pricing Default Swaps. But a crude approximation is that U should equal the duration of a 15-year bond at current interest rates multiplied by the amount by which the 15-year Lufthansa CDS spread has widened in the market. So if we assume, for example, that the Lufthansa CDS for 15 years has widened from our earlier 4% annualized to, let's say, 6% today as a result of the credit deterioration, and if we assume further that the duration at current interest rates of a 15-year fixed income instrument is around 10, then U would equal 20%. We remind you that the scenario involving a lease default without a bond default as well is highly unlikely. With these numbers in mind, our table can now be filled in to look exactly as follows, confirming on the right the various gains or losses that we calculated before. So the risks and benefits to Lufthansa become apparent. There is no net loss, the risks and benefits to JP Morgan become apparent. Morgan incurs no net loss under any of these scenarios except under the one that we have deemed very improbable. And in fact, Morgan would achieve some net gains under the two scenarios at the bottom. Furthermore, Morgan earns the positive carry we had described before prior to the date of a lease or bond default under the total position it had, which was shown in scenario 1 earlier and was equal to $250,000 per quarter, all while being almost completely hedged against the credit risk of Lufthansa. Before moving on to Chapter 3, we mention 3 issues that might complicate the analysis above. First, our discussion assumed that Lufthansa's payments under the lease do not change if the airline is defaulting on its bonds. In fact, the lease contract may include a step-up payment clause in the event of such a default. Second, we conveniently assumed that the lease payments represent only the financing charges, so to speak, and do not amortize the lease principal. Hence the final payment under the lease of $100 million in bullet form. In reality, most leases are structured so that the periodic lease payment represents partly the financing charge and partly some amortization of principal, exactly in the same way as an auto loan or a mortgage, a home mortgage. In those cases, Morgan would quickly become overhedged, since the CDS would remain $100 million notional, while the real principal at risk, if you like, under the lease would be amortized over time. And therefore Morgan would want to consider structuring the CDS notional so that it also amortizes over time and terminates the excess portion of the protection in tandem with the lease amortizations. Most importantly, we also assumed that the initial CDS spread was 4%, which, when we added that number to Morgan's 3% funding cost, still came out lower than the 8% return Morgan was earning under this lease. This enabled us to put Morgan in a position where it was completely or almost completely hedged regarding credit risk and still had some positive carry. But of course, any CDS rate or spread above 5% would have eliminated this carry and would have made it, in fact, negative. This completes chapter 2.